good afternoon, everyone. No worries if you didn't win the lucky draw. Hopefully in this session, you'll take away something more important. And for those who won the lucky draw, at least now, I guess you know what to, in this session, I'll kind of show you what you can use that lucky draw to allocate to instead. So, quick introduction. My name is Jordan Lee. I'm an ETF specialist at JP Morgan Asset Management, covering the Asia Pacific region. And my role as an ETF specialist is essentially to bring forth our US, Europe, and Asia investment strategies all across the world to investors in this region across financial institutions, sovereign wealth funds, insurers, banks, and also investors like yourself. So the title today, Volatility in Motion. Now, if there's anything that I'll walk you through in this session today, I do want to explore a single idea with you, and that is the idea of market volatility. Something that a lot of investors and what we are taught to fear and avoid when we are investing. Volatility itself can be turned into something that delivers a consistent monthly income and cutting through that noise. So as an old market saying goes, if it is unpredictable, it is uninvestable. Well, today with these strategies of the Equity Premium Income Suite, that will effectively cut through the market volatility noise and to give you an investable solution. So Equity Premium Income, active ETFs. Now, what are active ETFs? Well, over this time, I'll explore that with you. So thinking back, it sounds quite like an oxymoron, right? When you think about ETFs, you would think about passive investing, following the benchmark and just getting an exposure to the market. And active, well, there is traditionally actively managed strategies that you have to pay high fees or it's very difficult to access to. Now, I turn over to this side and taking a step back into the ETF industry. The ETF industry is relatively young. It started about in the 90s. And ever since then, it has quietly become one of the most significant investment vehicles in modern day investing. Now, looking at the scale over there, the ETF industry, we typically expect it to double every 5 years or so since 2008. And in today, the ETF industry sits at $20 trillion. But on active ETFs, it is a younger type of investment vehicle, and today it sits at $2 trillion, about 10% of the global ETF industry. But we expect the ETF industry to grow to $30 trillion by 2030. And what we have seen is that it's about a CAGR of 16% or so. And with the active ETF industry, we expect that number to grow to $6 trillion by 2030. Or about 36% CAGR. So with that in mind, and to put a shape to it, not only is the size of the ETF pie growing, and we expect it to continue to grow, but we also expect the slice of the active ETF pie to grow as well. So what is active ETFs? Well, active ETFs combine two components, active management, where you get to tap into the sophisticated research, security selection, and portfolio construction of the investment capabilities of asset managers like ourselves, JP Morgan Asset Management, where we employ about more than 1,500 investment professionals covering every single stock in the MSCI All-Country World Index. And combining that depth of investment expertise with the features and the benefits of an ETF, which is that transparency, liquidity, and cost. And so how has active ETFs, how has the industry shaped to be? How is it like today? So when we look at the active ETF industry, back in 2019, that's when it really started to pick up, gaining popularity. And back then, there were a couple of niche categories within the active ETF industry. It's mainly used for ultra-short fixed income, very specific use cases by large financial institutions. But look at where we are today. The use case and the categories for active ETFs look a lot more even. And now there's expressions across like large cap equities, general fixed income, different expressions that you would typically see as part of your portfolio's building blocks. Now, what has changed is that the active ETF isn't really a new concept. Actively managed strategies aren't new. Large financial institutions, your sovereign wealth funds have always used these actively managed strategies. What have effectively changed is now we have brought it into an ETF vehicle, and now it's accessible to you and I, all in the palm of your hands. And that's what I want to highlight, is that is why this is disrupting the investing industry today. They're leaning on to two of the best ideas of an actively managed strategy and the ETF vehicle itself. And that's why it's contributed to that huge growth in active ETFs and where we see that continuous growth, which is the main characteristics of transparency in an ETF vehicle. It's about taking ownership of your own investments, knowing exactly what you hold in your investments, every single line item, and more importantly, knowing what you don't hold. It's about the liquidity with an ETF vehicle. It's about getting access to intraday trading and trading on exchange as and when you want to. And of course, last but not least, the most important point everyone cares about, and that is cost. It's about offering a cost-effective solution to you as an investor. So when we think about active ETFs, you are no longer forced to choose between an actively managed strategy, which typically requires large minimums, or a separate account, or to choose between an ETF that's traditionally used for passive investing. Now you'll be able to get access to both, or through the FSM platform as well. And one of that use case or key category with active ETFs is derivative income, or equity premium income. And that's the topic that I really want to highlight today. Now, if you look at it, this chart over here, that line really tells a story. Now, looking back about 6 years ago, the derivative income space with ETFs is about only $6 billion. Today, these derivative income ETFs sit at about $180 billion. Now, what does this represent? The rise and demand of derivative income ETFs is because it's a signal to the increasing demand from investors for a dedicated outcome solution. What they do want is a consistent monthly income stream, irregardless of the market environment. What they are seeking for is a clear result, a clear investment objective, beyond just simply tracking the index. And over there, the blue shaded area in that chart, that is our JP Morgan Asset Management Equity Premium Income range. Now, we have been at the forefront of these derivative income ETFs. We were an innovator in terms of bringing these solutions into the ETF vehicle to investors like yourself. Now, these solutions aren't new. These strategies of writing call options, covered calls, aren't a new strategy. They have been used by large financial institutions, sovereign wealth funds, pension funds, and even the banks as a form of investment strategy for decades. What is new now is that now you can access it in the ETF vehicle. And at JP Morgan Asset Management, we do pride ourselves as a leader in this space, where today our suite represents around $80 billion. That's a very meaningful share of the broader derivative income category. Now, we have built this because we have been doing this for many years and many decades. And what's most important with such strategies is the depth and investment capabilities that you can rely on, but more importantly, it's the scale to deliver the results consistently. So I'd like to bring your attention to the 3 ETFs in the Equity Premium Income Suite. Over on the left-hand side, we have JEPG, or JEPG, which essentially represents the global equities exposure. Now, with a 12-month yield of around 8.8%. The one in the middle, JEPI, is the exposure to your US equities, and it is also our flagship strategy, the world's largest active ETF currently, giving a 12-month yield of around 8.3%. Now, those are 2 strategies. The annualized yield is around 7 to 9%. And last but not least, on the right, JEPQ, or JEPQ. That is essentially exposure to your US technology sector. And the 12-month yield of 10.22%. Now I'm going to pause there for a bit. 10.22%. The annualized yield is expected to be around 9 to 11%. And if you're familiar with the technology sector, they typically don't pay out income. You don't typically expect consistent dividends from exposure to the technology sector. But because of how this strategy works, essentially monetizing the volatility in the market to capture that yield of around 9 to 11% in the technology sector. So how do these strategies work essentially? I'd like to highlight two key building blocks to kind of explain how these equity premium income suites work. The first building block is your underlying equity portfolio, managed by our portfolio managers in JP Morgan Asset Management, researched by our research analysts to pick the underlying securities to represent the portfolio. And the second building block is the option overlay piece. Essentially, we write or sell out of the money call options on the respective indexes to capture the options premium. So we combine the two components of an underlying equity portfolio and then the options premium that we sell, you are able to capture a total return strategy of equity premium income suite. Now, it sounds a bit complicated, so let me simplify it for you. Think of it as the options premium as renting out a spare room in your house. That spare room will give you that consistent and regular income irregardless of the environment. And the underlying equity portfolio, that's effectively your home, right? It's subjected to the property prices in the market today. So let me dive a little bit deeper into the options premium and how do we capture that premium. Now, when we think about volatility, that's what we tend to avoid. That is what we don't want in the portfolio. But over in these strategies, what we are doing is we are monetizing that volatility through the options. Now, if you look on the gray shaded area of this chart, which represents the VIX, or essentially a measure of the volatility in the market, and the yellow line is the options premium that you are able to capture when you sell options on the index. What you can see is that as the volatility of the market spikes, correspondingly, the options premium increases as well. So for example, in key peak periods of market volatility, for example, in 2008, where we have the GFC, the options premium was at about 30%. And more recently, during the COVID outbreak, when there's another market drawdown, the options premium was at about 26%. Now, what this represents is that these strategies are able to sell the call options and capture the option premium, and effectively, all of the option premium is paid out to you as an investor. None of the yield or income is paid out through capital. And so tying that back together into the three levers of return, breaking through that two building blocks. With such a strategy, you are able to capture returns from three folds. Firstly, the dividends from the underlying equity portfolio. When you invest into a security, they'll pay out dividend, and that's what's paid out through the portfolio itself. The second component, that is the options premium. That's harnessing the volatility in the market and paying out all of the options premium as income to you as an investor. And of course, that last bit, which is the market participation. You still get exposure to the market through US equities, global equities, or even the technology sector, very similar to owning a home. And all of those combined gives you a total return portfolio called the Equity Premium Income Suite. Now, it sounds too good to be true because I did say that, well, this is something to weather the market environment, the volatility that we see in the market, and it gives you a total return portfolio. So immediately you're going to ask me, what is the catch? And I want to be honest with you about what this strategy is and what this strategy is not. So this strategy is not a strategy that will always outperform the market. The strategy's investment objective is not built to outperform the market in a strong bull run. But what this strategy works to do is to effectively give you that consistent income, irregardless of the market environment. So let me highlight here a couple of market scenarios. Over here is in 2022, from January to December. What you see is the reference to our world's largest active ETF, the choppy strategy. The S&P 500 ended the year at about minus 18%, with a volatility of 23%. The JEPI in this case ended the year at about minus 3%, with a volatility of around 15%. Why? It's precisely because of the options premium that it's able to capture every month, paying out as income, and also contributing to the total return of your portfolio. So not only is it monetizing the volatility in the market, but it's also reducing the volatility in your portfolio just because of the additional return stream. And more recently, in 2026, when we started the year, the strategy was relatively in line with the market. And then when geopolitical tensions start to break out and markets drew down, the portfolio was a lot more resilient. And then when more recently with the AI and memory stock boom, where we saw a very concentrated bull run, and that's where this strategy lagged behind a little bit. But because it was able to capture the income from the volatility from the geopolitical tensions, we are able to kind of stay smoothing the investor experience. And with such a strategy, it's really about diversifying the portfolio and help to distribute the risks across your multiple pillars of returns. And so effectively, to recap a key component of this strategy and what this strategy, how this strategy performs in the different market scenarios. So in a bear market, this strategy will typically outperform because there's an additional lever in returns. Now in a flat or sideways market, where markets are kind of directionless or they don't know where to go, effectively, you will be able to outperform as well because you get to participate in the market from the underlying equity portfolio, getting that capital appreciation, but at the same time, still harnessing that income from the market volatility. And last but not least, in a bull market, such a strategy might forego some of the upside because of the writing of the call options and capping the upside potential. But if a runaway bull market is your worst case scenario, then I guess for the rest of your portfolio, it is quite a good problem that your worst case scenario is a bull market. Which brings to my last point into such a strategy, which is your portfolio itself. Now, with such a strategy, I'm not expecting you to overhaul your entire investment strategy and use these strategies, but instead, just illustrating here over in this example, by incorporating 20% of the allocation into your JEPI, JEPQ, or JEPG in this case, what it gives you is that you can see an improvement in the risk-adjusted returns of your traditional portfolios. It's improving the profile of the traditional portfolios, and it's changing the way investors think about your traditional 60-40 or 80-20. It's about getting that consistent income, diversifying your return streams, all while still staying invested in the market. Now, essentially giving you the three main key points here across the JEPI, JEPQ, JEPG suite. Firstly, it's about balancing income and total return, getting that consistent income stream irregardless of the market environment, knowing what you can expect and what you won't expect. And it's about monetizing the volatility in the market, harnessing what investors are taught to fear, harnessing what investors are taught to avoid in their investments, and making it work for you, making volatility a friend and not an enemy. And last but not least is that downside mitigation. Because of that additional return sleeve, that two building blocks that I mentioned, this equity premium income suite helps you to be more resilient when markets are drawing down. And so to recap these three main points of JEPI, JEPQ, JEPG, all of these are available on the iFAST FSM platform, with JEPG and JEPI typically expecting around an annualized yield of 7 to 9%, and JEPQ, the exposure to the US tech sector. Because of the heightened volatility, we are able to make it work for us, delivering that 9 to 11% yield. All in terms of a management fee of around 0.35%. Now, remember what I said at the start, and we have come up to a full circle moment in this case, which that if it is unpredictable, it is uninvestable. Now, over here, these strategies is effectively to cut through the noise in every market environment, to give you an expectable outcome. It's to really turn an unpredictable market environment into an investable solution through these 3 ETFs. Now, I've come to my end of my presentation, but we do have a booth outside just across the exhibition hall. So my colleagues and I will be there. So if you do have any questions, we're happy to address them. Otherwise, have a fantastic rest of the day ahead. Thank you.